Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 stock picks is Phil Harris, manager of the Edentree UK Equity Growth Fund. Hi, Phil.
Hello.
So what's the first stock on the agenda today?
Right, first stock is a little company called Prism. This is a market leader in what they call robotic process automation. In simple terms, this is the automation of very complex tasks by software. So if we look historically, when companies saved money, they would outsource things to India. The next wave of the Industrial Revolution is actually to replace all the people by software. So complex tasks, as I say, that can be automated are something that is massively growing. This is a UK market leader, great. It's even bigger than IBM and all the big US tech giants in this area. £700 million UK company, growing at about 150%. Market leader, growing massively, got some great channel partners, great customers, and it's something that is going to take and change the world over the next 10 years.
And can you give me some examples of where this kind of software is already making up part of our everyday lives?
Yeah, sure. There's some great examples. For example, Vodafone use it in India. So if you buy the new iPhone, when you try to phone up to activate your SIM card, there used to be about 25 people actually there ready to take that call and to do that. Now, clearly when new iPhones were launched, there was a bit of a problem. You had to wait 24 hours. What they now do is use the software system. There are now 3 people in India to do the entire thing. It's automated. It's taken all those people out. Software robots, don't have holidays. They work 24/7. They obviously, have to be paid, but much less than people. And the whole process saves Vodafone a lot of money, makes our life much easier, and generally makes things much cheaper for everybody.
And what's the second stock today?
Second stock is a little company called Morses Club. So this is a mini Provident Financial, for those that don't know it. Morses Club basically does high interest loans, door to door, what they call home collected credit. It's a very old, very well established company. The problem at the moment in the UK is that most banks are earning very, very low returns on capital. They're all being hit by regulation and various problems, whereas Morses are earning very, very high returns on what they do. They're earning 27% return on equity. They're virtually unlevered, so there's no sort of massive leverage in the business. It's a nice family-type run business that's been around for an awful long time that can continue to grow for sort of mid-teens for the next 5 to 10 years. Very conservatively run, very lowly rated, nice yield, great growth prospects.
I suppose the obvious question there, as you say, it was a mini Provident Financial, and Provident Financial have had profits warnings and are in trouble.
Absolutely.
So
right.
How does Morses not emulate that kind of thing?
Well, interestingly enough, they've actually benefited what Provident have done. Now, Provident have actually had a problem because of the way they've changed their agents and the way the loans are marketed. And what they've happened is try to make everyone fully employed rather than self-employed. And they've upset a lot of their people, and they've obviously disappeared off to places like Morse Club. They've also upset the regulators with some of their products. They haven't actually been authorised by the regulators. So Morses very much have benefited from the self-inflicted wounds of Provident and are benefiting themselves. And oddly enough, if you look on things like Trustpilot, their customers love them. They get fantastic reviews. It provides a really good quality service. So completely benefiting from Provident, haven't done any of the silly things they've done, a great alternative to that company.
And what's the third and final pick?
Third one is ITV. For those that don't know it, it's the eponymous UK broadcaster. It owns a number of channels, obviously ITV one originally, but it's diversified into much more. It's the dominant UK advertiser, commercial television. It's basically been derated over the last couple of years as people have thought there's a structural decline in its markets. Actually, it's been a slight slowdown from some food manufacturing groups who are not putting as much advertising as usual. It's basically a growth company masquerading with a valuation of a value company. We think there's some great growth opportunities now going forward, not just for their core business, but in digital. They have a big content arm, so they're actually not really just the UK business now. They've got a new chief executive. The balance sheet is incredibly liquid and strong, so there's lots of things they can do there. Special dividends, more acquisitions, lots of growth opportunities, trading on less than 10 times, yield of 6. I say great growth business masquerading as a value stock.
Phil, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.